Hello everyone. Welcome back to FX Limit, your go-to channel for all things Forex and trading. Today, we have a very exciting topic to discuss. We're diving deep into the world of fundamental analysis and how it has been used in the past to predict currency movements. So, buckle up and get ready for an insightful journey through some real-life examples. Let's start off by understanding what fundamental analysis really is. In the realm of Forex trading, fundamental analysis is a method used to evaluate and predict the future movements of a currency pair based on the economic, social, and political forces that may affect it. Traders use this information to make educated guesses about where a currency pair is headed. One of the most classic examples of fundamental analysis at play was back in the early 2000s with the euro. The introduction of the euro as a common currency in many European countries was a major economic event. Traders and investors closely watched how different economies in the Eurozone were performing. They noted that the stronger economies like Germany would help buoy the euro, while weaker economies like Greece could potentially drag it down. By analyzing these economic indicators, traders were able to make more informed decisions about where the euro was headed. Another example is the impact of interest rates on currency values. The US dollar is a great case study for this. The Federal Reserve, which is the central banking system of the United States, has a significant influence on the value of the US dollar through its control of interest rates. When the Federal Reserve raises interest rates, it usually leads to a stronger US dollar because higher interest rates provide higher returns on investments in US dollars. Conversely, when the Federal Reserve lowers interest rates, it can lead to a weaker US dollar. Traders who understand these relationships and closely follow the Federal Reserve's meetings and announcements can use this information to predict movements in the US dollar. Now, let's talk about the role of political events. The Brexit vote in 2016 is a prime example of how political events can impact currency values. When the United Kingdom voted to leave the European Union, it sent shockwaves through the Forex markets. The British pound plummeted as uncertainty about the UK's economic future increased. Traders who paid close attention to the political climate and were able to anticipate the outcome of the vote could have positioned themselves to profit from these large movements in the pound. Commodity prices also play a crucial role in currency movements, particularly for countries that are major exporters of certain commodities. Take Australia, for example. Australia is a major exporter of iron ore. When the price of iron ore is high, it tends to lead to a stronger Australian dollar because the country's exports are earning more revenue. Conversely, when the price of iron ore falls, it can lead to a weaker Australian dollar. Traders who keep a close eye on commodity prices and understand these relationships can use this information to predict movements in the Australian dollar. In conclusion, fundamental analysis is a powerful tool in the Forex trader's toolkit. By understanding and analyzing the various economic, social, and political forces that influence currency values, traders can make more informed decisions and potentially profit from currency movements. Whether it's keeping an eye on interest rates, political events, or commodity prices, the key is to stay informed and use that knowledge to your advantage. And that's a wrap for today's episode on FX Limit. I hope you found this discussion on fundamental analysis and its role in predicting currency movements helpful. If you did, make sure to hit that like button and subscribe to our channel for more insightful trading content. And of course, if you have any questions or topics you'd like us to cover in future videos, leave a comment down below. Until next time, happy trading.